All right, so I have a question for the room. Jim, Jake, did either of you participate in the theatrical arts in either high school or college? Any theater, any former theater kids among us?
I can say with a certainty that I did not participate in the arts or theater. No, that was not my thing at all.
Wasn't in your wheelhouse?
It was
Not
not
even
in
a
my
little?
wheelhouse. Not even a little. I mean, I definitely admired people who can do that, and my kids do stuff like that. But I'm a left brain. Is that what I am, or is that the right brain
I've
person?
never been sure of those. I've heard about that for decades, and I can never get it right.
Yeah, yeah. No, I was scared to death of getting in front of a crowd, and let alone have any theatrical skill to
And yet here you
go
are.
with it. And here I am.
Yeah. Yeah.
Who would have known?
Jake, same question.
Fourth grade was my last appearance on stage. So yeah, I haven't been in the theatrical arts since. So, but I think that's probably for everybody's benefit that I haven't.
Yeah, yeah.
Well, in what might be a shock to nobody, I was quite involved from the ages of, gosh, I want to say 8 to, let's call it 20. I think 20 was around the last production I was a part of. And while this was normally scripted drama, comedy, and musical, I did occasionally dip a toe into the world of improvisational theater. And to that end, I was thinking we might start today off with a little improvised role play. So Jim, Jake, you are going to role play as yourselves. I am going to be a client, and we are sitting down to a meeting because I am scared to death of the market. I've been reading some headlines. I've been hearing the phrase bear market. The word recession is being thrown around. People are talking about CPI. And I'm pretty worried about my portfolio, and I'm starting to think I might want to go to cash. So I'm wondering in this situation what you as my advisors might say to me.
Yeah, I might have to reschedule this meeting.
that is not good improv, Jenna.
But it's honest improv. And that's what improv is.
I watched, I don't know, maybe it's like a 10-minute thing on improv. Apparently, one of the things you're supposed to always do is say yes. And I think in this situation, there is some like something applicable about that because, in response to that question, yes, it's okay to be scared. It's okay to have some fear right now. Has anything else changed in your life situation that would warrant a change in your investment portfolio? We remain long-term investors and objective-driven investors. So has anything changed in your life circumstances or objectives that would necessitate a change? We can't control what markets are doing right now, but you're in a great position to weather this storm.
Yeah, Jake, my initial answer was reschedule the meeting because as advisors, these times are really where they're the hardest times, for us because there is so much fear and anxiety out there that's driven by, constant news feeds and, portfolios going down and, markets being volatile. So it's very, very difficult. And I think what you mentioned is, a lot of it's built around, fear and anxiety. And so recognizing that to start out that, these times are actually pretty scary and that's okay is a really, really great place to start. I'm glad you saved me on that. That was good. So, thank you.
And you know what? Just like that, improvised client Zach is feeling a little bit better about things, and he's feeling better just in time for episode 7, if you can believe it. Episode 7 of Conversations with Bay Point. I'm Zach Frank, no longer improvising. That is really who I am, and I am joined as ever by my castmates, Jim Kintowski, a founder and partner here at Bay Point Wealth, joining us from Annapolis, and Jake Sadler, a partner here at Bay Point Wealth, who is joining us from beautiful Asheville, North Carolina. And today we are going to do a deep dive into the very fears that we're discussing. We are going to talk about what to do when the stock market gets rocky, what to remember. And we are going to be aided in this venture by our friends at Dimensional Fund Advisors. which is an investment management firm that provides mutual funds and ETFs that many of our clients are likely familiar with. And they produced a very useful white paper just in the past few months at the close of Q2, titled "Weathering a Stock Market Storm." And this contains 3 very useful bits of information on what to remember and what to think about when navigating the downward vicissitudes of the stock market. It's really useful. It's on our website. I highly recommend checking out the written content. But to start out with, I'm going to turn first to Jim, so we can discuss the first point that the article makes. And that first point is a recession is not a reason to sell. And I'm wondering if you might be able to talk just a little bit about why that could be the case. A lot of people hear recession, they're freaked out. They're thinking immediately, if not about their job, then they're thinking about their portfolio. And those tend to be the 2 things that one might immediately worry about in a time of recession, which as of right now, the board of economists that determine whether the U.S. is in a recession has not yet said that we are, though the strict economic definition of 2 negative quarters of GDP would say otherwise. So there's a lot of uncertainty. And amid that uncertainty, Jim, why might not it be a reason to sell?
Yeah, Zach, that's a really good question. I mean, the biggest part of that is a recession, and what's happening in the economy is not necessarily tied to the markets. And I think what you described with the board that determines a recession and announces it, in your definition that you mentioned, it's 2 negative quarters of GDP. And if you think about that comment right there, that's historical. So, we're looking in the past and we're saying, hey, what has happened over the last 2 quarters? We've had negative GDP and boom, we're going to announce that we are in a recession. And so if you think about that, that means that you most likely were in a recession. And that doesn't mean you're going to continue to have negative GDP. In the market, if we can say the market thinks, a lot of people talk at the market like it's a living body. The market is forward thinking. And so most likely during those 2 months of negative GDP, you've already been experiencing negative investment returns. And so by the time it's announced, it's typically from a market perspective is looking at a recovery and how that recovery might happen in the future, which tends to produce positive investment returns. There you go.
Yeah, the lag effect is very real, and it's really tempting for everyone to want to kind of directly link what's happening in the stock market with what's happening in the economy. But the way that we're measuring each of those things and the kind of the way each of those, the market broadly, operates versus kind of economic data, there's a fundamental difference in kind of what we're looking at. One's looking in the rearview mirror and one is attempting to look ahead, and forming expectations about all the information that's currently out there. And so where we kind of see the 2 collide is where perhaps data comes out and, from the panel of economists, the guys in white coats, if you will, that are out there studying, these things and putting together all this data. When that information comes out and it's different than what the market already has built in as its expectations, that's when we see that kind of sign of this pronounced volatility and some of these differences between, the market and the economic data become kind of all happening in real time, if that makes sense. So we get some bad numbers coming out. It's different than expectations in the market. So the market jumps quite a bit. And then we're just left thinking, okay, the market and the economy, they're doing the exact same thing at the exact same time, but they're not.
A key point there is real time. And so in order to, I guess, sell for a recession, you would have to be able to predict these things before they happen. So I heard you mention that, when information comes out, it may be different than expectations. you'd have to make a prediction, quite frankly, that information is going to be different. And so you'd be sort of guessing, and you'd be guessing against what everybody else thinks. So it would be extremely hard to do.
Mm-hmm. Yeah, I mean, at the end of the day, the general, trends that we see is that markets are moving in advance of what we're hearing about the economy broadly. So markets will decline ahead of the point where, we're clearly ahead of the point where we're saying we're in a recession, or decline before that point. They'll climb earlier than the economy is beginning to really rebound and recover.
Yeah, and the last point I'm going to make there, Zach, before you take over, is a lot of times what you see is literally when you feel like nothing else, or the economy's at its absolutely worst state, like the unemployment's bad, we got things going on in Russia and China, we got all this stuff going on. So you're like, oh my God, how could this possibly be a good, positive investment outlook? And that precisely, a lot of times, is when things change and the market starts to go up.
Yeah, I think that's a really good point, because it really gets to kind of this behavioral component with how we as investors and human beings are navigating all of this information and trying to process, what's happening in the markets, what's happening in the economy. And inevitably, in periods of time like we've experienced this year, we're just inundated. We're just hit with the fire hose of information. And there's a whole lot of fear, tied to that, and rightfully so. But just it's human nature to kind of reach that breaking point and that point of exhaustion with the news, and kind of there's just the outlook can't possibly look good. And it's at that point of exhaustion where we see behaviorally that's the point where investors are most likely to kind of capitulate and make that move. Like the hypothetical investor, Zach, at the beginning, kind of tempted to move to cash, but that unfortunately is kind of precisely the wrong time to do it. So it's at those moments where we're exhausted and we want to capitulate that we really need to hold fast, even tighter.
I'm glad you mentioned, Jake, the behavioral financial aspect of it. Because that impulse to move to cash, or to move to safer, less risky assets. So of course, assets that have less potential upside when the market is trending positive again. That classic loss aversion, right? If you move to cash in that moment, you're basically locking in what you're scared of, right? I mean, the thing you're worried about happening has already happened. Your portfolio has already suffered the loss. You move to cash and you are cashed out at the position, you were scared of. The bad thing is in the past.
Oh, that's such a good point, Zach, because it really kind of draws to the front this kind of difference, to kind of bring some jargon into the mix, between risk and volatility. And we were just talking about this the other day. Risk and volatility, while they on the surface kind of seem very similar, maybe the same thing, they are different. And so, volatility is that point where, okay, we've seen a sharp decline in the value of your portfolio in markets broadly. But it's risk that kind of brings in that behavioral component that says, okay, now I'm going to do something. Now I'm going to take action and kind of lock in the position that I'm in. And while it may feel really good in that moment to kind of hit the pressure relief valve, you've locked in your current position and you're on the sidelines for the recovery on the other side. And that can come very sharply and very unexpectedly. And so the temptation is, okay, I'm going to get out now and I'm going to figure out when to get back in. But there's a real danger in doing that.
Yeah,
you will miss that recovery.
You definitely feel good like when you sell everything and you're sitting in cash, But the harder part to do than selling things is to get back in. I've seen that over and over and over again, with people historically being in this business is, making that decision to sell is an easy one because you're in this sort of panic mode and you're like, I'm just going to relieve this pressure. And then, 3 years later, there's been a full recovery, returns, or you would have been way better off had you stayed in the market and you're still sitting there in cash. And that's the hard part to manage is actually getting back in and taking the appropriate risk that's going to help you achieve your investment goals. Being in cash is really unlikely way of helping you reach your investment goals.
And not to belabor the point too much, but it's interesting that you mentioned the difficulty of getting back in once you decide to go to cash, right? Because it's like anything. The longer you put something off, the longer you don't do what you have a nagging sense you should do, the harder it gets. Let's say you miss a great expansionary period for the market. Whether it's a 1-day rally or 3 to 6 month period, or just the kind of bull market that we were experiencing in 2021. You miss that, and it's just going to make it harder to get back in, right? Because you're sort of, admitting that, oh, I missed it before, but now I'm going to do it. There's a sense of shame in having missed out that just makes it harder to get in after the fact.
Yeah, and nobody's admitting that the market's now good. So.
No, we're not. We're certainly not saying like it's all's well. Let's just kind of move on upward. But I think one really interesting point made in the article we're actually kind of more or less talking about, is that the U.S. If we just look at the U.S. market, we have seen over the past century positive returns for 1, 3, and 5 year time periods following a decline in markets of 20% or more. And so it speaks to that point. Okay, you get to that point, you're down 20% or more. That does not feel good. What is waiting on the other side? And if we look back at the evidence, following these steep declines, we do have that expectation of positive returns, even in relatively short time periods, such as 1 year or 3 years. It doesn't happen in every one of the time periods, but that's the evidence, on average.
Yeah, and no doubt. I mean, I don't think people should really be thinking about selling when there's a recession. They should be thinking about buying. I mean, everybody talks about the strategy of, hey, let's buy low and sell high. How hard to do that, though? That's really difficult to do. I mean, because there's a lot of anxiety when it's down and it's on sale. And if you can do that, if you can be disciplined enough to do that, then it can really pay off in the future.
Yeah, we are 100%, goals focused, plan driven investors. And, if something's changed in your situation, again, kind of speaking to that question, should I move to cash? If something's changed in your situation, then maybe something in the portfolio does need to change with regard to kind of that, risk return profile that, suits your needs. But otherwise, we are investing systematically, not based on emotion and prediction. And it's that systematic effort that allows us to kind of tune out the noise of what's going on around us and kind of always, like Jim said, buy low, sell high. That sounds really great to do. And the only way that we know how to do that in any way consistently is with a system in place and not based on predictions.
Yeah, and Jake, I think that that gets to the one of the points that the article is making as well, which is it may be a good time to reassess your portfolio and your plan. And that may be is operational, because it's true. During a period of significant market selling off, or even just simple volatility, it may occur during that time period that you realize your plan has changed in a way that would impact your investment decisions, either how much you're investing or how you're allocated. But it shouldn't necessarily, really ever be the driving force in the allocation.
No, I mean, I think at every opportunity, every moment in time where there's a lot of volatility in the markets, if we've experienced a steep decline, we're in a bear market, the news doesn't sound so good. I think these are all really good times to just sit with your thoughts on what you're doing with your investment portfolio. And kind of think about, okay, where am I? How is this built to meet my needs? Kind of ask some tough questions about what you're doing. We would encourage anyone to do that, because I think what you'll get in the end is an answer that kind of provides some measure of peace of mind for what you're doing. When you look at, okay, this portfolio is built in a way that it's aligned with my goals. Okay, fundamentally, the risk return profile between stocks and bonds hasn't really changed. I'm in a good place. I don't know what's going to happen next. And you can kind of accept it and go about your day.
Yeah, I agree. It's always a good time to reassess. And the honest answer is if you're having trouble sleeping at night and you're going through one of these time periods, maybe you do have a little bit too much risk. And if you go back and revisit your plan and you say, hey, I can get away with, 5% return instead of a 6% return, and that means, taking a little less risk, that's okay. And if that keeps you invested for the long term, that's probably a smart decision to make, but make it based on, fundamentals about yourself, not what's going on in the current environment. That will crush you if you try and make those decisions based on, day-to-day activity. I mean, because we all see what happens. I mean, the market can be up in the morning and down in the afternoon, and if you sell everything, you could be you kick yourself quite hard. The other way to make changes is, maybe over time, if you're saving money through a 401k or a retirement plan and you want to be a little bit more conservative, do it with new money instead of, selling everything or rebalancing during a volatile time. Say, hey, I got this new cash coming in, instead of being, 80% of the market, I only want to be 70% of the market. So let me put this into something a little bit safer.
And Jim, I'll just kind of add on. I think it's a really good point on kind of that anxiety that can build up, and doing that assessment of kind of where am I with my portfolio, my investments. Because if you're not sleeping at night, then there's something else kind of going on, and if that anxiety just continues to build without asking some questions about what am I doing with the portfolio? Is it aligned with kind of my main objectives? And then that anxiety will just kind of get bigger and bigger under pressure to the point where, and I think I used the term earlier, you hit the pressure relief valve, because that's what it is. That anxiety that's not letting you sleep at night, okay, that's a little uncomfortable. But if it just kind of sits and kind of festers for a while, then it can really lead you to a point where you make a really big decision that is probably not in your best interest.
Yeah. And it may not even, you may not even have to worry about it. Like I've seen people, be worried and scared, and they only have like 30% in the market, so they have a conservative portfolio because they did planning at the start. They're talking about volatility, and you're like, wait a minute, you don't even have a lot of exposure, to these markets. Just understanding how you're invested, like you've mentioned a couple of times, is really helpful. Just reevaluate.
Yeah, I mean that sounds like one of the chief incentives to be sort of plugged in on the education side and to know exactly how you are invested and to be attuned to that plan, right? Who wants to take on subjective risk and self-assessed feelings of anxiety if they don't need to, if if they simply aren't in the positions whereby that anxiety can be realized.
Yeah, sometimes we make things up in our own head.
We sure talk a lot about feelings and anxiety and behavioral tendencies. You do almost need kind of a degree in psychology to kind of do what we're doing, or just to be an investor. I think to kind of understand that interplay between kind of who we are as human beings, how we're wired, and what we're doing, with our money.
And that's a good segue, Jake, because the final point that the article makes, which is time the market at your peril, which I did want to touch on. That self-knowledge, the question of introspection and knowing who you are as an investor and as a risk taker is so important to that, right? Because there's and I think I have a feeling that you have some data or a chart to back this up. I just have a sixth sense about it, that the most outsized returns on that the market is going to provide the investor who stays with it happen on vanishingly few days. I mean, there's the data suggests that if you invest $1,000 in 1990 and wait till 2022, and you have, I think it's something like $22,000 or $20,000 based on that one initial investment. I mean, 1,200 of that was based on a single day's outperformance or outsized performance. And I was wondering if you might speak a little to that.
That's really right. And you're talking about dollar term figures, which is actually better. We kind of focus on percentages, and percentages are kind of hard for us. again, as human beings, we're not wired to like process percentages as well as we are in dollar terms because we can directly relate it to kind of our day-to-day life. But I think just to start, like a couple of interesting, dates to point out: 1962 and 1970. So these were the last 2 years, or the most recent 2 years, where the first half of the year for U.S. stocks was worse than what we've experienced so far in 2022, first half in 2022. In each of those years, and I'm not saying at all this is what's going to happen in 2022, but in each of those years, the market recovered quickly in the second half of the year by 15% and 27% respectively in 1962 and 1970. And so I think to just point to, okay, when we look in, and that's been part of the headlines, this is the worst first half of the year in decades and decades. Well, when we look back at kind of what's been similar to that, we have seen, very sharp rebounds, quickly thereafter. I wasn't even alive in 1962 or 1970, but hey, that's just the evidence. But I do have some data from during my lifetime, which is actually really interesting. It's one of my favorite, kind of at least thought experiments to kind of go through, and that's the effect of missing those best days in the market. And we're talking about we're long-term investors. We're investing. Well, we don't even want to hear about data that's less than 12 months. Like we want to hear decades worth of evidence and data, but we're talking about days in the market. And it's really interesting. If you look at the U.S. market as a whole, stocks, since 1990, right? I got to do some simple math, at 32 years. So that just the S&P 500 had a annual average return of 10.76% per year. If you missed the single best day, your return would have dropped to 10.38. If you had missed the 5 best days, your return would have dropped under 10% per year to about 9%. And if you had missed the best 25 single days, well, you would probably have the worst possible luck of anyone out there to miss the best 25 days out of the past 32 years. But your return, instead of 10.76%, would have been 5.55% per year. So the kind of moral of the story is really meaningful returns can happen in single days. They often happen in single days in the midst or at, the bottom of these, terrible conditions in markets when that fear and anxiety is just, investors are reaching that kind of point where they're throwing up the white flag. They can't take it anymore. And boom, that's when we get these best days. So I say you'd have to have pretty bad luck. I think the reality is that to miss these best days in the market, you would really have to be kind of giving into that fear on a consistent basis. And you can see the effect of that. Your return drops, in half. You kind of may as well have not been invested in stocks to begin with. You may have just really wanted to focus on other investments that would have had a more similar return to what you got at 5.5%.
I was quickly doing the math as you were describing the amount of days needed to have half of that return. Talking about you're talking about people not being wired to think in terms of percentages, but I was curious. So not accounting for the extra days of leap years, I believe it's just over, to hear you talk about, just over half of that entire return, that over 10% on average return, was determined by, if I have this right, 0.2% of all days. That's not even 1% of all days. It's 1/5 of 1% of all days. That's what half of the return was dependent upon. That's staggering. That's sort of eye-wateringly small.
It really is kind of eye-wateringly small. At the end of the day, we as investors, we want and need to capture returns when and where they are available. We just don't unfortunately know in advance when and where those returns are actually going to materialize. And so I think that's kind of the danger that you put yourself in, getting in and out of the market, attempting to time the market, kind of moving to cash at a point in time to kind of ease the fear and anxiety with the hope to get back in. And Jim, your point is spot on. Getting back in the market is even harder than making that decision to get out to begin with. And the result, you may feel good, but you will not be in your seat to capture those returns that are there for the taking.
Yeah, and if we look at recent time periods, Jake, I was closer to that 1960 and 70. I'm a few years older than you, but not quite there. If you just look back as recently as 2020, with all that volatility, going on when we're going through the height of the pandemic, I mean, we saw swings, 5, 7, 8%, within days. And so if you made that rash decision, you say, hey, I can't take this volatility, I'm going to sell everything, and you sell it on a day where the market's down, 10%, or I shouldn't say 10%, but it's down significantly. And then the next day you look at the market, it's all green and it's right back up because of something, a president said, or a decision that was made to provide economic support. I mean, that's emotionally difficult to handle. And those are the days that you miss out on, and really can drive those lower returns. And so you're right. You might have been in a more conservative portfolio to start with. And that may be the answer a lot of times. And quite frankly, doing that job in the front of tying your risk in, what your investment portfolio looks like to what you actually need is probably, in my opinion, the most important part of making these decisions. It's making sure from the start that you're in a place that's right for you. Not saying it's easy to do, and there's some science, and there's some creativity, and there's some art to it. But trying to get there from the start is, in a proactive way, is the best approach.
100%. That's kind of where my thoughts were heading as well. Jim, and just in terms of, kind of one of those responses, has anything in your situation changed? In a perfect world, if you're doing proper planning, to the best of your ability, and that's to the individual as well as to the planner, you're trying to be proactive and look out into the future. Okay, what changes might I anticipate in my situation in the next 12 months, in the next 24 months, in the next 5 years even, because that can materially impact how your investment portfolio is structured. We kind of want at every point along the way that you are in the best possible position to weather the storms. We don't know when the storms are going to happen. So if something's changing in your situation, let's get ahead of it.
Yeah. Storms are going to happen, Jake. I can tell you that much. And they're going to be difficult to get through. That's the one thing I've learned being in this business. There's really no avoiding difficult times and storms. So,
well, that's a really good point. There's no avoiding it, and it's always different. Unfortunately, as investors, we have to embrace uncertainty. It's a little uncomfortable, and it gets even more uncomfortable because the circumstances are always different. And it's really tempting as investors to say, this time is different, so I'm going to do something different. But the reality is the circumstances in markets are always going to be different. It's that uncertainty in and of itself. We know storms are coming. We just don't know when.
And with that, I believe, gentlemen, that we are at time. So thank you to our listeners and viewers for tuning in yet again. We'll be back next week with even more conversations and tips on navigating all financial waters, rocky or temperate. But until then, I'm Zach Frank, and I was joined by Jim Kantowski and Jake Sadler, and we will see you next time.